Good day, everybody, and welcome to our third quarter presentation. We've started doing these presentations, and we hope that you find these enjoyable. I'm joined today by Mark Learmonth, CFO, who will run you through some of the more important numbers. But generally, as an overview, the third quarter has been a challenging quarter again because of the gold price. But as we've told you before, Blanket is a great operation, and it continues to make money and cash even in these difficult times. And there are a few aspects of the development of the Life of Mine project that we'll go into in more detail. And hopefully the explanation of the numbers will give you some comfort, and you will be very excited about looking at some of the pictures that we'll show you regarding the new shaft development and the general expansion that Blanket is embarking on. So without further ado, let me hand over to Mark and ask him to run us through some of the numbers. And thanks once again for joining us.
Okay, thank you, Steve. I'll just run through some of the slides. All of these slides are available on our website. So that you can follow them in more detail. But just turning to the overview of the profit and loss account, and you can see that on a quarter-on-quarter basis, revenues increased in Canadian dollar terms from 13.5 million Canadian dollars to 15.8 million Canadian dollars. We've got to understand we're dealing in Canadian dollars here, so to some extent that increase was due to the weaker Canadian dollar against the US dollar. But having said that, in the quarter we did produce about 1,000 ounces more gold than we did in the comparative period, and so that did help to increase the revenues, notwithstanding the lower realised US dollar gold price. The royalty charge is down from $0.9 million to $0.8 million, and that reflects a reduction in the royalty rate, which we've signalled previously. Production costs in Canadian dollar terms seem to have increased significantly from $7.2 million to $10.2 million in the third quarter of 2015. That's a 42% increase in Canadian dollar terms. But as you'll see in a moment, once you convert that to US dollars, the increase was 10%. And again, you'll see in a moment that on a cost per ton mined basis, we've actually managed to bring the cost down quite significantly. So gross profit for the quarter was 4.8 million compared to 5.4 million in the comparative period. Looking at G&A, again, G&A appears to have gone up quite significantly from 1.8 million Canadian dollars to 2.2 million Canadian dollars. Once you strip out the non-recurring items, so those non-recurring items are specifically some costs associated with remediating some long-standing South African income tax issues. So there's quite a significant proportion of costs associated with that, and then there's some relatively small costs associated with the closure and the termination of Zambia. Once you strip out those costs, the Canadian dollar quarterly charge is about 1.5 million Canadian dollars a quarter. Annualise that, you end up with about $6 million for the year, and that $6 million for the year compares with last year's charge of $8 million. So whilst it may be difficult to see at this stage, over the fullness of time you will expect to see the G&A cost come down, and I expect that once we get out of these non-recurring items, as we sort out some historic issues, you'll see that flow through into a lower G&A charge. Depreciation has gone up, and again that reflects the higher capital base as we continue to invest in the Blanket mine. Other $1.9 million of other income, the bulk of that is foreign exchange gain. And so actually when we come to work out a normalised earnings per share number, we do strip out those foreign exchange gains, because that just reflects the fact that in Canadian dollar terms our cash balances are worth more than they were in US dollars. The finance charge again seems to have gone up quite significantly from basically $0 to $500,000. That does include about $400,000 of interest payable to the South African Revenue Services on old tax charges, which we've just rectified. So PBT $2.9 million for the quarter compared to $3 million in the comparative quarter. Not much change there. The tax charge has come down significantly, as we said it would do. So the tax charge for this quarter was about $0.9 million. The bulk of that is actually deferred tax. That's a non-cash item, and just reflects the difference between the accounting treatment of investment and the tax treatment of investment. which means that the net profit for the quarter is $2 million, which is significantly higher than the net profit for the comparative quarter of $1.3 million. Working that through to earnings per share on an IFRS basis, we're looking at 3.3 cents a share for the quarter compared to 2.2 cents a share for the third quarter of 2014. Stripping out the funnies, so stripping out the foreign exchange gain, stripping out the non-cash deferred tax, and also removing the non-recurring G&A expenses. For the quarter, earnings per share was 5 cents, and for the 9 months it was 10.2 cents. It's worth noting that earnings per share of 5 cents is probably the best quarterly showing we've had for 4 or 5 quarters. So it's in a difficult operating environment, I think these earnings numbers are very creditable.
I'd like to run you through the gold production graphs that we've got up on screen now. The left-hand graph represents the quarterly gold production in ounces. And as you can see, for 2015, we are seeing the quarter-by-quarter uplift in gold production. That is as per our plan was built, and we're very pleased that this is coming to fruition. Obviously, the increased gold production is a factor of tons mined, tons milled, the grade, and the actual recovery through our CIL plant. The recovery is a fairly constant 92 to 93%, so that doesn't warrant much comment. The grade is, as we have explained before, we're still in the period of recovering from a relatively low grade position towards the end of 2014, but that was all built into the life of mine plan. And the grade, as we open up more areas underground, will slowly start to improve, but we're still running at a relatively low grade, about 3.2 grams per ton. The most pleasing aspect that we've witnessed during the third quarter is that we've got record tons milled. For the first time, and it's evident from the graph, that we are able to handle more and more ore and ore waste underground, and that is an absolute consequence of the completion of the tramming loop that the mine completed in June. We're now starting to see the benefit of that, and it will be a sort of a foundation for the uplift of production that we're anticipating for next year. But this is clear evidence that the tramming loop has added to the logistical flexibility underground, and it's very, very pleasing to see that we have achieved the tons that we have achieved. So I'm going to hand back to Mark and let him run you through some production numbers.
Thank you, Steve. Turning to page 6, we've got some information here on production costs. So what you see in the table, the top bit of the table really refers to total production costs, and then towards the bottom we break that down into its components, being wages, consumables, and electricity. So as I've already mentioned, you can see that total production costs in Canadian dollars increased by 42% from $7.17 million to $10.17 million. Again, if you convert that back to US dollars, the increase is actually only 10%, from $6.6 million US dollars to $7.3 million US dollars. Then again, if you express that in terms of the tons milled, on a cost per ton milled, the cost actually went down by 7%, from $67 a ton to $62.60 a ton. Again, if you look at it in terms of the cost per ounce, the on-mine cost per ounce was basically stable at $668 an ounce. And the all-in sustaining cost did increase somewhat, from about $950 an ounce to just over $1,000 an ounce. That's a 6% increase. And that was largely driven by an increase in sustaining capital expenditure. And the increase in sustaining capital expenditure was really attributed to 3 or 4 relatively high cost components. So we bought 2 new drilling machines, we bought a new rope for the new central shaft, and we engaged in some construction activity on the mine village, which employs the vast bulk of our workers. We need to do that, so as we need to employ more workers to sustain the growth in the mine. So on an overall basis, you can see that the production costs have been relatively stable. Just breaking that down into wages, there was the wage bill increased from about just over $2 million to $2.5 million. That's a 20% increase. But if you look at that in terms of the wage per man hour, that's a 10% increase from $2.62 to $2.87. And that reflects the 5% pay rise that we agreed with our workers between last year and this year. And the difference between 5% and 10% will be normal overtime working. So whilst the labour cost was up, you'll be able to see that the consumable cost is down. On a cost per tonne milled basis, the consumable cost fell from $23.29 to $21. And also electricity, the electricity cost per tonne milled has come down from $17.58 to $15.72. And you may recall that in previous quarters, we had indicated that the electricity bill was somewhat higher than we'd expected. We've investigated that. We worked out what the difficulty was, and it's pleasing to see that the electricity cost per tonne milled has come down. So as we've managed to control the cost per tonne, as we expect to see the grade improve over the course of the next 4 years, and also as we expect to see further cost reductions as we realise economies of scale by spreading the fixed costs over more production, we do believe that this mine is well positioned for the production cost per ounce to come down quite significantly, which should further boost cash generation as we increase production. Steve, talk about page 7.
Thanks, Mark. The graph is again an illustration of the sensitivity of the blanket mine operation to the number of tonnes milled and the outcoming cost per tonne. I think we've explained before that Blanket has a high fixed cost component in its cost structure, and as we push more and more tonnes through the operation, we get the economies of scale. And this graph, the red line is the cost per tonne, and again very pleasing to see in Q3 a distinct reduction in that cost per tonne, as the blue bar shows that the tonnes are reaching nearly 120,000 tonnes in the quarter. We're ending up with that very pleasing $62 odd a tonne. And our anticipated outcome will be, as the life of mine plan develops, there will be more and more tonnes, and we would be therefore expecting that the cost per tonne will become more and more competitive and just make this mine a greater cash generator.
Looking at the G&A cost, what you see on this slide is a breakdown of the G&A cost, quarter 3 2015 compared to quarter 3 2014. I would say that the quarter-on-quarter comparison is actually a little bit fine, because some of these costs are distorted by specific activities within a quarter. So sometimes it may be better to look at these things on a sort of a longer term perspective. But just looking at the total, you can see the total's gone from 1.7 million Canadian dollars to 2.1 million Canadian dollars, a 24% increase. But once you convert that back to US dollars, it's actually reasonably stable, 1.59 million US compared to 1.64 million US. But looking at the 2013, quarter 3 2013 numbers, you can see that within that total, there are some items that we don't expect to recur. So in particular, 209,000 in respect of tax penalties arising from the remediation of some historic South African income tax issues, and unrecoverable VAT also arising from that same situation of 334,000. So once you've stripped out the non-recurring items, being the tax penalties, the unrecovered VAT, and some continued smaller expenses for Zambia, once you've stripped those out, you're running at a total cost, Canadian dollar cost per quarter, of about $1.5 million a quarter, $6 million annualised for the year, and that compares to the 2014 total G&A charge of about $8 million, just more than $8 million. So you can see, whilst it may not be immediately apparent here, over the course of coming quarters, we do expect to see the quarterly G&A charge come down. Taxation has historically been quite a significant expense for us. Whilst the taxation charge in Zimbabwe isn't particularly high at 25%, we were incurring tax leakage arising from movements of cash out of Zimbabwe, both by way of of management fees and dividend. And we also have incurred income tax in South Africa and the United Kingdom. You can see in this quarter the total tax charge was just less than $1 million compared to $2.5 million for the first half and $6.6 million for the whole of last year. And what's interesting to see is the reversal in this overall charge of the income tax. So whereas for the first half we had an income tax charge of 1.1 million, this year it was actually a credit of just under $1 million. And that reflects the fact that because of the higher level of investment at the Blanket mine in Zimbabwe, the tax charges that we booked in the first half of the year were reversed because the profit of the mine was more than outweighed by the capital expenditure. Continued to incur some smaller withholding tax charges as we continue to get management fees out of Zimbabwe, and the increase in the deferred tax, well, that's a non-cash item which we strip out from the calculation of the adjusted earnings per share, and that just reflects the high level of capital expenditure which is treated in a different way for tax purposes than it is for accounting purposes. So an overall reduction in the tax charge, and as we continue to invest quite large amounts in Zimbabwe, we'd expect that overall taxation charge will remain at lower levels than it has done historically. It's worth saying that management continues to investigate ways to simplify the group tax structure. For a relatively small company, our tax structure is unnecessarily complex and does give rise to inflexibility and leakage. And so we are actively considering ways to make that more efficient and to streamline it.
Let me run you through the earnings per share for the quarter. We have a adjusted EPS that we report, and we've got the IFRS EPS. And it's very pleasing again to see in the third quarter that the adjusted EPS is actually at a record high for the period of this reporting, the whole of 2014 and 2015. Sitting at nearly 5 cents a quarter, and having stripped out the non-recurring items which were significant in this third quarter, we would expect that even in this low gold price environment to see a repetition of that as we go forward. The normal IFRS EPS is also positive, and it's also better than we have reported in the past. And as we had guided, that this is all a consequence of dealing with cost savings where we can, sticking to the knitting and getting the best efficiencies out of Blanket. So the EPS is all heading in the right direction, and long may that last.
Just turning to cash flow, what you see on this slide is the quarterly cash flow numbers. So starting from the first quarter of 2014 up to the third quarter of 2015. What's immediately apparent, a couple of things are immediately apparent here. The first is that the cash generated from operations in the third quarter at $1.1 million was significantly lower in previous quarters. That reflects a combination of the lower realized gold price, but also some working capital absorption, as you'll see when we talk about the balance sheet. So working capital is absorbed as we build up stocks to cater for the increased activity levels, and inevitably we do have higher receivables, particularly VAT receivables, because there's just a greater amount of purchasing, so we're paying more VAT, and it takes time to get that VAT back. Taxation relatively low, interest relatively low. Also significant is the extent to which we've increased the net capital investment. We said we were going to do this, and so we've said we're going to be spending $70 million over a 5 or 6 year period. And so you can see in the third quarter, the rate of investment did increase very significantly from sort of 3.9 in the first quarter, 3.4 in the second quarter, up to 6.8. So continued very significant capital expenditure. But you'll see that the cash position at the end of the quarter, whilst it's lower than it has been in previous quarters, is still very robust at just less than 20 million Canadian dollars. We do expect the cash position to fall somewhat as we continue to invest heavily in the business, but I think it's very clear that the overall balance sheet position remains very robust. And then just finally finishing off from my perspective on the balance sheet. Again, what you see here is a summary of the balance sheet. So fixed assets clearly have increased as we've spent $6.8 million. The additional increase on top of that really reflects the devaluation of the Canadian dollar. And you can see the increase in the overdraft. We have a $5 million unsecured overdraft facility in Zimbabwe, of which $2.8 million is drawn. And at the bottom you can see non-cash working capital. So the non-cash working capital has increased from about $4.3 million at the end of December 2014 up to $7 million. Part of that reflects a normalisation. The working capital position at the end of December was abnormally low, so it has normalised. And on top of that, we've also seen an increase in working capital as we grow the business.
Thanks, Mark. Right, let me wrap up this presentation by looking at some of the outlook items. We've said many times that our primary focus is the revised investment plan, and that really does continue to be the primary focus area. And there'll be some pictures flashing up on your screen to show you success and expansion at the central shaft working area. And it really is beginning to get a life of its own. Next year, we're looking at the higher production levels, and that's all going to be a function of the improved underground logistics and the opening up of new areas as per the life of mine plan. And we should start seeing some benefit coming out of the number 6 Winds area, which was the sort of second leg of the life of mine plan. And Central Shaft will just continue from its pre-sink stage, which is where we are now, into the fully blown sinking phase. And the next set of pictures that you will see will show great advancement when we have a headgear up and we've got the kibble winder all in operation. We are also continuing to do some work at GG and Mascot, which are our exploration satellite properties, and we will continue to look at those areas, and if possible we would be looking at building a pilot plant there to prove some of the metallurgical aspects of those two areas. And obviously in these difficult times our approach will still be one of conservatism. We do need to look after the treasury because it's what we have for the rainy day, and we anticipate that the gold price environment will continue to be tough, but we have a uplift in production next year, which, as I've said before, results in a lower cost per ton, a lower cost per ounce. And we therefore look forward to continued and increased cash generation out of Blanket to fund the expenditure that needs to take place during 2016. So yeah, that's pretty much from Mark and I don't know if you've got any closing comments, Mark?
The lower gold price environment, we are intending to recapitalise Blanket modestly. Blanket's financial projections were based on a gold price of $1,200. The gold price has been lower than that quite significantly now in the last quarter. And so to make sure that the Blanket has the financial capacity to implement the revised investment plan, we are intending to recapitalise it to the tune of about $5 million, which will come from our treasury. We've maintained treasury at relatively high levels, so we can accommodate things like that. And the intention will be to put that $5 million into Zimbabwe without impairing or adversely affecting at all Blanket's status as a fully indigenised company. But so that's ordinary course of business, and will mean that Blanket is therefore secure in its ability to implement the revised plan and reap the benefits of that in the course of 2016 and onwards.